CNBC TV18, embarking on a quarter century of excellence.
Hello and welcome to this special State of the Economy edition. The November inflation number is out. It is below market expectation, coming in at 5.55%. The CNBC TV18 poll was 6%. So it's a significantly lower inflation number than what we were led to believe. That's a good 45 basis points lower. So it's really very, very good news that we are getting. We were preparing for a near 6% inflation number. In fact, even over. There were many people in the poll who even thought it would be over 6%. So let's get through the details. Food price inflation is still a shocker. It's 8.7%. Our poll threw up 8.6%. So compared to the 6.61% for October, food inflation is clearly a worry. And the core inflation will take a little while to calculate. Meanwhile, let me give that one industrial growth number that is most important. IIP number comes in at 10.2%. CNBC TV18 poll was 10.5%. No, don't run away with a happiness of double-digit growth. The year ago number was minus 4.1. So that explains why, you have such a big number. It was a very, very bad base. So over 2 years, the growth will be more like 3% CAGR. Not a flattering number, but much better than the year ago number. Let's get to more important details. Food price is up 1.1% over the month. We've got urban and rural inflation, not of much significance. Urban inflation is 5.26. Rural inflation is 5.85. So that is where it is biting the most inflation in rural areas. But even then, it's not 6%. So I think there is still a lot of positivity in these numbers. We'll wait for more details. Okay, October industrial growth is 11.7. Okay, then what was 10.2? Informist poll was 10.2. Sorry, the October industrial growth is 11.7%. So that's a tad better. Ours was 10.5 in terms of a poll. But I must still caution that this comes over a very low base. Now, who are the culprits? The culprits are clearly, again, vegetable index, up 5% month on month. So I assume onions got company from tomatoes, and that's led to the vegetable index going up 5% month on month. And pulses and related products continue to remain very expensive. It's 1.6% higher month on month. So I think the year-on-year number will continue to be fairly significant, 16-17%. So that makes for two culprits, veggies and pulses. The third culprit would be cereals. That's up almost 1% month on month. It's 0.9% higher month on month, and therefore the year-on-year number is likely to be fairly stiff at about 13-14%. Okay, I now have a few more details, and I'll read them out to you just a minute. Okay. So to go through all of them, cereals and products up 10.27% year on year. Eggs again up about 5.9. Meat and fish not very bad, 2%. Milk and milk products up 5.75, a significant cooling off from the over 8% that we saw Jan to June. Oils and fats again very soft. Remember a year ago post-Ukraine war, oil products were very expensive, minus 15%. That minus run has been going throughout calendar 2023. Fruit up 10.95%. That's a new problem. Fruit prices becoming expensive. Vegetables are up 17.7%. That's ugly. And even versus pulses. Now pulses is a problem, is a danger. It's 20.23%, and it's a staple diet in India, in a country which has a large vegetarian population. Pulses are an important source of protein, going at 20.23%. Sugar 6.5%, spices 21, but they've been at 21.5 for some time now. So food and beverages on the whole is 8%, but food alone, like I told you, is 8.7%. Clothing up 4%, footwear up 3%, 3.3 actually. Then we come to the miscellaneous, which is largely services. In the services sector, the overall miscellaneous is up 4.3. So that's absolutely soft. Much of the core sector will come out of this. So 4.3 over there, miscellaneous. Personal care and effects is 7.83. My suspicion is gold is contributing to it. Education is up 5%. Recreation up 3.15. Transport and communication 2%. Health 5.5%. And household goods and services 3.5%. So that's the overall picture in terms of the inflation. The last number that I want to give you is CPI core, which expectedly is lower at 4.1. Our poll was 4.25. October was 4.3. So coming in at 4.1, that is singly responsible for bringing the inflation down to 5.55%. I mean the headline, despite the fact that food is at 8.7. Now with those preliminaries, I will read out the IIP numbers in a bit. Let's get the first comments on inflation. Joining me now are an elite panel of economists and bond experts. Aditi Nayar, Chief Economist, ICRA, Rupa again, it's today, the Chief Economist at L&T Finance, Nikhil Gupta, the Chief Economist at Motilal Oswal, and Devang Shah, the co-head fixed income at Axis AMC. Gentlemen and ladies, thank you very much. Rupa, first thoughts, 5.55 is a solace?
Well, compared to the expectations, it is a tad lower. But point is that sequentially we are seeing a lot of increase in the prices of both perishables and non-perishables. And if you look at the progress of Rabi sowing so far, the area sown under pulses, as a percentage of normal sown area is very low. For some pulses like moong dal and all, it is 6% of normal area. So that is going to be a real worry. And I think the government supply side measures along with RBI's tightening have helped contain, inflation. But the supply side measures cannot be continued indefinitely. So inflation definitely remains a risk, especially coming out of supply shocks, given that this is an El Nino year and there are concerns about the yield of Rabi crops as well.
Okay, that certainly remains. This may not be the worst number we have seen. We have to wait and see whether pulses and cereals become even more expensive. Aditi, would you change any numbers because of this 5.5 for the full year?
Thanks, Lata. Actually, today's number is in line with our expectation. We had forecast the CPI inflation to come in at 5.6%. So while there's some differences in some of the internals, like food is a little higher than what we expected, but fuel and housing have actually come in a little lower. Headline is in line with our projection, and I suppose for December we're now looking at a number coming in the range of 5.6 to 5.8%. But overall for the year as a whole, 5.4% seems to be a number that we can hold on to for the time being. I fully echo Rupa's concerns on the Rabi side, the sowing being below last year and the reservoir levels being trailing last year and the historical levels quite a bit. So I think the concerns on food inflation are definitely going to persist for the next few months, even if we have a normal, reversal of the vegetable prices back to trend. So this is something that we need to watch out for, and next year having a normal monsoon is going to be very crucial for us to get the CPI inflation average back to the 4% handle.
Okay. Nikhil, any thoughts to add? The Reserve Bank stays on hold. Will this number mollify them to any extent at all?
Thank you, Lata. Yes, Lata, I think this 5.5% is much lower than the market expectations. We were at 5.9%, and while looking at the details, I find that the food prices, inflation in fruits, which has come in much lower than what we were anticipating. Core inflation is broadly in line. So definitely this will provide some relief to the policymakers. I don't think the RBI needs to change the interest rates in any meaningful way in the next few quarters, which we have been maintaining for some time now. But it was definitely better than what the market was fearing.
Yeah, the market did fear 6% plus. Devang, do we have a bit of a rally on our hands, or all bets are only on the US CPI at this point?
So as you rightly highlighted, I think probably markets will be looking at what's happening today evening on the US CPI, tomorrow is a Fed meeting. So I think even if the rally is there tomorrow morning, I think it will be restricted to a couple of bases. Again, our markets are now focusing on the overall tightness on liquidity, and because in effect we have been now having the operative rate at 675 for more than 2-3 months. I think markets for a broader rally need the operative rates to start looking or moving towards 6.5. If that is not happening, yes, couple of bases, 2, 3, 5 bases is easily possible. But a structural move, we need the operative rate to change.
Okay. Okay, I'll come back to inflation in a bit. Let me now read out the industrial growth numbers. There are some very positive numbers here. Already 11.7 for the month of October is much better than the CNBC TV18 poll of 10.5. The Informist poll or Cogensis, I would know, is 10.2%. So it's a significant improvement. And the September growth number has also been bumped up to 6.2 versus the 5.8, which was the provisional number. So, all across, it's a very good industrial growth picture. I think we should stop inflation and start publishing the industrial output numbers. Industrial output has come in at 11.7 and it compares with last month, not 5.8 but 6.2. So that's much better. This makes the April-October industrial growth to 6.9. Now I must warn you that there are some base effects, and that's particularly visible in electricity. Electricity has grown at 20%. And why not? The year ago, inflation? I'm sorry. Electricity has grown at 20%, and that has largely been made possible because of a significant, fall in power output in the year ago October. It was highly monsoon month. There were coal shortages, if you remember. Again, a fallout of Ukraine. So we did have a very poor electricity number year ago, and that explains why electricity looks very good at 20%. Manufacturing is also higher fairly significantly at 10.4%. That compares with a minus 5.8. So electricity is 20.4 over 1.2 last year, but manufacturing is up 10.4 over a minus 5.8. So it's not really a spectacular number when we look at manufacturing. And the third one, mining, has also done fairly well at 13.1, which comes over a 2.6% year ago. So I would think mining and electricity have a lot to say for itself, but not so much manufacturing. Among the others, capital goods has come in at 22.6, but that's again a minus 2.9 last year. So poor base, but still 22.6 is no laughing matter. Even with that minus 2.9 last year, it's still a two-year CAGR of 10%. So that's big. Primary products 11.4, intermediate goods 9.7, again over a minus 2.3. Consumer durables up 15.9 versus minus 18. Wow, for consumer durables, excellent number. I would assume the resumption of demand for two-wheelers and passenger vehicles was seen in the month of October. Maybe that's what's showing up. I'll go to the experts in a minute. Consumer non-durables as well, 8.6 versus minus 13. So spectacular growth in non-durables and a little puzzling. So let me, I have to take a commercial break. Give me a minute, we are back in a jiffy with our experts. With our guests, Aditi Nayar of ICRA, Rupa Regedisra of L&T Finance, Nikhil Gupta of Motilal Oswal, and Devang Shah of Axis AMC. And the verdict on inflation is it's definitely lower than what the street expected. But as Rupa pointed out, there are still dangers lurking in terms of a potential rise in Rabi crops where the acreage is below par, is subpar. But the manufacturing number looks very good. Overall manufacturing is, like I told you, 11.7% over a minus 4.1 last October. But if you look at the April-October, it's up 6.9% over 5.3 last year. So it's good over a 5.5%. If you're doing a near 7%, that's not a laughable matter. Electricity is up 8% over a 9.4 last year, April-October. Manufacturing is up 6.4% above a 5% last year, and mining is up 9.4% over a 4% last April-October. So it looks like a strong showing. Would you agree, Rupa, is that something great is going for growth?
absolutely. I think Indian economy has shown excellent resilience and rebound from the pandemic. And of course, there could be some favorable impact of low statistical base, because last October also was Diwali season. So, the factories were closed for a few days and all. So that might have contributed. But if you look at the sequential momentum in terms of high frequency indicators, we had seen in the month of October, very rich GST collections, then also, this higher production of tractors, two-wheelers, etc. And also, even the exports growth and non-oil, non-precious metals imports growth, again it had come in the positive growth zone. And you see, automobiles, white goods sales, as you rightly pointed out, must have been encouraged by the festival season, and we are seeing somewhere this momentum continuing despite the fact that inflation worries are lingering.
Actually, when you look at the breakup as the IIP press release gives you, manufacture of motor vehicles, trailers and semi-trailers is 24.4% month on month. And April-October is, not month on month, sorry, year on year, October over October. And April-October, the growth is 11.5%. So it looks like, just 1 month's performance has pulled up the average so significantly. Again, manufacture of machinery and equipment is up 26.1%. These are all components in IIP in manufacturing. Electrical equipment is up 13%. And other manufacturing, which is of course a basket, is up 30.9%. It's actually done pretty well. Nikhil, first thoughts on growth. Do you think RBI's 7% is justified now?
Yes, Lata. So IIP was expected to be close to 11%. So 11.7% doesn't really give that much of a surprise.
Okay.
And we know that manufacturing GVA, just like in Q2, Q3 will also be as good. Not as good as actually what it was in Q2. We expect it to decelerate a little, but it will still be probably in double digits growth. So based on all that, even if we still do not think 7%, we find it a little more optimistic, but 6.7, 6.8 is easily achievable.
Okay.
Which in itself is much better than what we were anticipating earlier, and considering that it grew more than 7% in the previous year.
Yeah,
so overall growth has been
positive, absolutely. And let's remember that US has also grown at 5.2% in the third quarter. So there is, of course, a lot of push coming from many quarters. Aditi, last thoughts. We are in a great Goldilocks place. Inflation lower than expected, growth higher than expected.
Yeah, Lata, definitely. I mean, these are a good positive set of numbers. I'm going to leave you with a little bit of a caution from my side.
Okay.
2 points. One, if we look at electricity, it grew by about 20% in October. The YOY growth dropped to about 6% in November. And for the early part of December, we're in a contraction. So that's one of the reasons why I'm not going to get carried away with the October numbers. Secondly, if we look at the IIP for the month of October, compare October 2023 with October 2021, when Diwali was in the same month. So basically, like to like on the festive season. Consumer durables and non-durables are actually lower.
Oh.
The index values are lower in 2023 October than they were in October 2021. So until I don't see the full month of November numbers and average out October and November together to get a full picture of the festive season, I am not going to change my GDP growth forecast upward too much. I do think that the MPC's latest forecast may prove to be a little optimistic. So in line with what Nikhil said, anyways, I'm going to wait to see the November numbers to get a fuller picture without the base effects.
Okay. That's a useful lesson, Aditi. Next time I'll come with the 2021 numbers as well, so as to have the correct measure of optimism. Devang, what would be the bond bracket, or do you want to keep your options open till you see the US number?
No, so our understanding is currently I think bonds are trading in a very, very narrow range. And as I told you, I think probably crude has significantly reduced. I think it's from all perspectives, global bond markets yields have significantly retraced from 5% US Treasury, now we are at 4 quarters below. And probably if the US CPI reading is significantly lower, we can touch 4%. I think our markets are looking more from a perspective because today there is, from an RBI perspective, it doesn't look like a hurry for them to cut rates.
Oh.
You look at the inflation cycle, it is definitely significantly lower, but on the growth numbers, they are doing a stellar performance. So I think unless and until we move to a easy liquidity environment or we see significant change in trend from Fed where they start cutting rates, our markets will continue to trade in a range with downward bias.
Absolutely.
That's our thoughts.
Yeah, absolutely. And aggressive growth should keep the RBI a bit tight even on liquidity, because aggressive growth, higher than expected growth, can always lead to inflation. But as Aditi warns us, there is perhaps, and Nikhil, there's some slowdown down the corner even on growth. Rupa, thanks for the caution on inflation as well. Rupa, Aditi, Nikhil and Devang, thank you very much for joining us. The message from the two important numbers that came on the state of the economy is that we are in a Goldilocks state, at least as of now. Inflation lower than expected for November and growth higher than expected for the month of October. On that note, we wrap up on this edition of the State of the Economy. Stay tuned with CNBC TV18. Lots of news and updates lined up for you.